Well, welcome back to Finance Uncut. On today's episode, legendary investor warns us to buy gold and silver.
Famed investor Jeremy Grantham has a call that's drawing a lot of attention. He's predicting a collapse in stocks, and he says it's underway. The Fed won't be able to save us from this one, in his opinion. This is some pretty interesting stuff. Bloomberg News editor-at-large Eric Schechter joins us now. Eric, let's talk about first Mr. Grantham's track record as a bubble caller.
Well, Jeremy Grantham has a pretty darn good track record as a bubble caller. He is, as you know, a value investing legend. He's been in the markets for 50 years and calling bubbles for almost as long. He called the great Japanese stock and real estate bubble back in the late 80s. He called the tech bust in 1999, 2000, and he was onto the housing bubble here in the United States before the financial crisis of 2008. So his track record is awfully good, and he says this bubble, what he describes as a super bubble, is only one of four the United States has seen in the past century. It is a multi-sigma deviation from trend. That's a statistical term. He says it comes around exceedingly rarely, and when it does, the patterns are unmistakable, and the inevitable result is, as you say, a crash.
Okay, so that's some pretty tough medicine to hear, and the track record obviously is there. Let's talk about some of the scenarios that he's mapping out here.
Well, again, I'm going to use some statistical terms, but if you look at a plot of the S&P 500 over time and then do what's called a regression analysis, you'll see that there's a trend line. And the trend line comes in way below where we are right now, even after the sell-off of the past few days. And I think it's worth listening to Jeremy Grantham in his own words, Greg. I think you have an excerpt of an interview I did with him queued up, because if you think back to where the S&P 500 was at its peak in November, roughly 4,800 points, this is where he says it's going to go.
Trend line, being slightly generous, is 2,500. And most of the great bubbles, the super bubbles, go below trend and stay there for quite a while. In the Greenspan era, that tendency stopped. In 2000, yes, the NASDAQ came down 82%, which was fairly brutal. Amazon came down 92%. But the Federal Reserve raced to the rescue so loudly and strongly that they stopped the decline in the S&P at trend line. It only declined 50%. 50% is a hell of a big decline, but it was only enough to get it back then to trend. This time trend is at most 2,500. And I would expect, even if the Federal Reserve tries to do the same, it will be hard to prevent the market from declining to that level.
Greg, two things to add right there. The first is that if the S&P 500 actually drops to that 2,500 trend line level, it would be a peak to trough decline of 48%, so roughly at that 50% marker that he was talking about. But the second more important thing to talk about right now is what he had to say about the Federal Reserve. He has been steadily critical of Fed policy for many, many years. He says that going back to Alan Greenspan, the Fed is guilty of inflating these bubbles, including the super bubble we're in right now. But successively, starting with Greenspan, cutting rates when the markets fell out of bed, and then subsequently Bernanke, Yellen, and Powell, there's been this implied put. People could count on some kind of a Fed rescue. Now that we live in inflationary times, the Fed's hands are cuffed by injecting more liquidity into the market. With quantitative easing, say, it would just be pouring gasoline on the inflation fire. And that, as we both know, is something the Fed cannot do.
All right, so it seems like everyone's in a very tight spot, according to Mr. Grantham's call. There's always skeptics, though, Eric. I mean, what's the skeptical view on his take?
Well, I'll give you two. The first is he made the bubble call first a year ago. And as everybody knows, the S&P 500 went up 27% last year, or almost 27%. He says, in fact, what was going on underneath the surface validates his point, and stocks have been selling off since November. And so while it did take a few months for this to start to build. He thinks we're firmly in sell-off territory already. However, there is another skeptical note to add, which is that as a value investor, as you know, loves cheap stocks, he has been stuck to a strategy that really hasn't worked for about 12 years. And those who follow Jeremy Grantham's value investing advice since the financial crisis are way behind the rest of the market. And so that invites some skepticism as well. If Jeremy Grantham is such a sage, how has he been wrong for all these years? Grantham would counter that, yes, value has been out of favor. But if you listen to his advice, after this crash is finished, you'll end up well ahead of where the speculators are.
Well, I'm guessing Jeremy Grantham watched my video I did the other day, Sell, 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 where we talked about a market crash and we spoke about reversion back to trend line and means and standard deviations and whatnot. And I went through all that in this video. And if you guys haven't seen that, I'll put a link in the description below. I highly recommend you watch it. It's basically very similar, using very similar information and data that Jeremy Grantham is talking about. And I'll put a link in the description to this video that I did just before Christmas, where I said huge stock market crash. And yes, I did put shared a little clip of Robert Kiyosaki, but in here in this video I was talking about the signs that I'm seeing and the signs that I recommend you guys follow that just tell me that we are getting very toppy in the stock market, and perhaps it was about to begin to roll over. And I think since I did this video, it's pretty clear that we have seen it roll over. The question now, is this the beginning of a market correction? And how big is that market correction? Does it turn into a crash that Jeremy Grantham is warning about? And the other thing that just watching that clip and what Jeremy Grantham had to say really reminds me of Japan. And he mentions Japan and the Japanese stock market and real estate market. And I'm pretty sure I've done a video on this as well, but it reminds me of Princes of the Yen. My good buddy, Professor Richard Werner, he wrote the book Princes of the Yen. There's also an awesome documentary movie called Princes of the Yen. Once again, I'll put a link in the description below. It's on YouTube. I'll put a link in the description below. Go watch Princes of the Yen and look at how the central planners blew an asset bubble in the 80s and then basically pulled the rug from under it. And that Japanese debt bubble just burst. And, well, both the real estate market and the stock market haven't got back to its late 1980s high. So how do we navigate all of this? How do we invest? And why does Jeremy Grantham actually tell us that we should be buying gold and silver? He does. Well, we're going to check out this article from Yahoo Finance entitled Jeremy Grantham Doubles Down on Crash Call. It says sell-off has started. And in this, he tells us to buy gold and silver. Jeremy Grantham, the famed investor who for decades had been calling market bubbles, said the historic collapse in stocks he predicted a year ago is underway, and even intervention by the Fed can't prevent an eventual plunge of almost 50%. In a note posted Thursday, Grantham, the co-founder of Boston asset manager GMO, describes US stocks as being in a super bubble, only the fourth of the past century. And just as they did in the crash of 1929, the dot-com bust of 2000, and the financial crisis of 2008, he's certain this bubble will burst, sending indexes back to statistical norms and possibly further. That, he said, involves the S&P 500 dropping some 45% from Wednesday's close and 48% from its Jan 4 peak to a level of 2,500. The Nasdaq Composite, already down 8.3% this month, may sustain an even bigger correction. I agree. I wasn't quite as certain about this bubble a year ago as I had been about the tech bubble of 2000, or as I had been in Japan, or as I had been in the housing bubble of 2007, Grantham said in a Bloomberg Front Row interview. I felt highly likely, but perhaps not nearly certain. Today, I feel it is just about nearly certain. In Grantham's analysis, the evidence is abundant. The first sign of trouble he points to came last February when dozens of the most speculative stocks began falling. One proxy, Cathie Wood's ARK Innovation ETF, has since tumbled by 52%. Next, the Russell 2000, an index of mid-cap equities that typically outperforms in a bull market, trailed the S&P 500 in 2021. Finally, there was what Grantham calls the kind of crazy investor behavior indicative of a late-stage bubble. Meme stocks, a buying frenzy in electric vehicle names, the rise of nonsensical cryptocurrencies such as Dogecoin, and multi-million-dollar prices for NFTs. This checklist for a super bubble running through its phases is now complete, and the wild rumpus can begin at any time, Grantham 83 writes in his note. When pessimism returns to markets, we face the largest potential markdown of perceived wealth in US history. It could, he said, rival the impact of the dual collapse of Japanese stock and real estate in the late 1980s. Not only are equities in a super bubble, according to Grantham, there's also a bubble in bonds. The broadest and most extreme bubble ever in global real estate, and an incipient bubble in commodity prices. Even without a full reversion back to statistical trends, he calculates that losses in the US alone may reach $35 trillion. Grantham is a dyed-in-the-wool value manager who's been investing for 50 years and calling bubbles for almost as long. He knows his predictions are fodder for skeptics. One obvious question, how could the S&P 500 advance 27% in 2021, its seventh best performance in 50 years? Stocks were poised to plummet. Rather than disprove his thesis, Grantham said the strength in blue-chip stocks at a time of weakness in speculative bets only reinforces it. This has been exactly how the great bubbles have broken, he said. In 1929, the flakes were down for the year before the market broke. They were down 30%. The year before, they had been up 85%. They had crushed the market. Seeing the same pattern that played out in every past super bubble is what gives him so much confidence in predicting this one will implode similarly. Grantham pins the blame for bubbles for the past 25 years mostly on bad monetary policy. Ever since Alan Greenspan was Fed chairman, he argues, the central bank has aided and abetted the formation of successive bubbles by first making money too cheap currency and then rushing to bail out markets when corrections followed. 100%. Now investors may no longer be able to count on that implied put. Inflation running at the fastest clip in 4 decades limits the Fed's ability to stimulate the economy by cutting rates or buying assets, Grantham said. They will try. They'll have some effect, he added. There is some element of the put left. It is just heavily compromised. Under these conditions, the traditional 60-40 portfolio of stocks offset by bonds offers so little protection, it's absolutely useless, Grantham said. He advises selling US equities in favor of stocks trading at cheaper valuations in Japan and emerging markets, owning resources for inflation protection, holding some gold and silver, and raising cash to deploy when prices are once again attractive. Everything has consequences, and the consequences this time may or may not include some intractable inflation, Grantham writes. But it has already definitely included the most dangerous breadth of asset overpricing in financial history. So, there's the warning from Jeremy Grantham. And, I've argued that the bond market's the biggest bubble I've ever seen. The stock market, I shared in that last video, 75% above trend. Definitely. I've been looking at Russia and Japan. I've shared that in other videos where I'm investing. Emerging markets, I've said I'm bullish longer term, but I'm bullish India and Indonesia and countries like that. As you guys know, I've been talking about commodities for a very long time. I've shared about energy commodities, but also metal commodities. You guys know what I think about gold and silver. And I've shared also on this channel that I have cash. I'm sitting on quite a little bit of cash, mostly in US dollars. Why US dollars? Because when this crash happens, that Jeremy Grantham's talking about, there's going to be a liquidity event. And people are going to need dollars, US dollars. And so there's going to be a rush, a scramble for US dollars. And I think that will push the US dollar into a bubble. And it's not just me who thinks this. Jim Rogers thinks this is how it plays out. So as much as we hate, Jim Rogers hates the US dollar, and ultimately we think it's going to where all fiat currencies end up, we do think when this happens in the short term that the US dollar will turn into a bubble. And for me, being an Australian, the Aussie dollar will fall significantly. This is, Brent Johnson's dollar milkshake theory. And I know a lot of you guys dismiss him and dismiss his theory. I don't. And that's why a portion of my portfolio is actually invested for Brent's thesis, because it does add up to me. I can see it playing out. I can see gold going up at the same time that the US dollar goes up. But our Aussie dollar will fall. Now, Brent thinks it's going sub 40, so into the 30s. I don't see that. I hope he's right, but I probably won't have the patience to wait that long. If the Aussie does fall close to 50, I'll probably pull that trade and sell my US dollars and buy Aussie dollars, because at that point, also I believe that some very quality gold and silver stocks in particular here in Australia will sell off in this market crash, and I'll be able to convert those US dollars into a lot of quality gold and silver stocks here in Australia. So I've got that play as well. So yeah, I'm very similar to Jeremy here. I do sit on cash, mainly US dollars for that dollar milkshake theory trade. You guys know I love gold and silver. I am a sound money guy. I believe we're heading for an inflationary decade ahead, and obviously Jeremy is warning about inflation here, and so having some resource, for inflation protection, but also looking at emerging markets. For me, that's India and Indonesia that I'm most bullish on in the longer term. But Japan and Russia provide very cheap valuations with companies with no debt and very good free cash flow. So anyway, that's my opinion. What do you guys think? Love to see your thoughts and opinions in the comments below. If you like this video, please hit that like button. Really do appreciate it. Take care, everyone, and I'll see you again on another episode of Finance Uncut.